The moment has finally arrived. After more than 6 decades at the helm, Warren Buffett, the man widely regarded as the greatest investor of all time, is stepping aside as CEO of Berkshire Hathaway. For many shareholders, the immediate question is, what happens next? Berkshire isn't just another Fortune 500 company. It's practically synonymous with Warren Buffett himself. For decades, people have said Buffett is Berkshire. But here's the reality. Buffett has quietly been preparing for this day for years. He's been building a structure designed to survive him, a fortress of businesses, managers, and investment philosophy. So, in today's video, we're going to unpack exactly what the future holds for Berkshire Hathaway once Buffett is no longer at the top. We'll break it down into 3 parts: the businesses, the stock portfolio, and the emotional impact on the market. And finally, we'll explored why this transition could actually create one of the biggest opportunities for investors in decades. Let's start with the businesses themselves. Berkshire Hathaway is not a typical corporation. It's more like a 3-part financial machine. First, there's insurance. Berkshire fully owns some of the most recognized names in the industry, like Geico and National Indemnity. These companies generate enormous cash flow, money collected from premiums before claims are paid, and Buffett has long used this float as rocket fuel for investments. Second, there's non-insurance operations. We're talking about giants like BNSF Railway, one of America's largest freight networks, and Berkshire Hathaway Energy, which powers millions of homes. Add to that companies like See's, Candies, Duracell, and Dairy Queen, household names that continue to produce steady profits year after year. And third, Berkshire has its massive stock portfolio worth hundreds of billions. This includes huge positions in Apple, Coca-Cola, Bank of America, American Express, and more. These stakes pay billions in dividends annually, strengthening Berkshire's fortress balance sheet. Now, here's the key point. Buffett has not been deeply involved in the day-to-day running of these businesses for years. His role has shifted toward oversight, while trusted executives have handled operations. The insurance side has long been led by Ujit Jain, one of the most respected names in the industry. On the non-insurance side, Greg Abel has quietly built an impressive track record running Berkshire Hathaway Energy and is set to succeed Buffett as CEO. So while Buffett's departure feels monumental, the actual operations of Berkshire are already in strong, capable hands. The companies under the Berkshire umbrella are well-managed, resilient, and designed to function independently. This means that on the business side, Berkshire is not just going to survive without Buffett, it's positioned to keep thriving. Now let's turn to the second pillar: Berkshire's stock portfolio. This is where things get more complex. For decades, Buffett has been known as the ultimate stock picker, the man who compounded wealth at nearly 20% annually for over 60 years. Berkshire's portfolio today is worth over $300 billion, anchored by positions in Apple, Coca-Cola, American Express, and Bank of America. These holdings alone generate billions of dollars in annual dividends. But the question everyone asks is, who manages this portfolio once Buffett is gone? The answer is, they already do. Since around 2010, Buffett has had 2 trusted lieutenants overseeing billions on Berkshire's behalf. Todd and Ted Weschler both came from successful hedge fund backgrounds before joining Berkshire. Over time, their responsibilities have expanded dramatically. Each now manages roughly $15 billion in assets within the portfolio, making independent decisions while following Berkshire's principles of value investing. Buffett himself has praised them, calling Todd and Ted outstanding business minds. And importantly, their style mirrors the Berkshire way: patient, disciplined, and focused on long-term economics rather than short-term trends. Meanwhile, Buffett will still remain as chairman for the time being, even after stepping down as CEO. This ensures continuity during the transition. But make no mistake, the framework is already in place for Todd and Ted to take full control of the equity portfolio when the time comes. So while nobody can truly replace Buffett's instincts, Berkshire's investing machine is not dependent on a single man anymore. The transition of the stock portfolio has been happening quietly in the background for over a decade. Now comes the tricky part. The market's reaction. Even though Berkshire's businesses and stock portfolio will be in strong hands, the day Buffett officially steps down or eventually passes away will almost certainly trigger an emotional response on Wall Street. We already saw a glimpse of this when Buffett announced his retirement as CEO. Berkshire stock slipped more than 5% almost instantly. And remember, nothing about the company's fundamentals changed. That drop was pure emotion. So imagine the day we see headlines like Warren Buffett has passed away. Institutions may feel pressure to reduce exposure. Retail investors might panic. And some funds, bound by mandates, may be forced to sell when a legendary CEO departs. The result, maybe 5%, maybe 10%, perhaps even more. Not because the underlying business has suddenly stopped working, but because sentiment and psychology rule in the short term. It's important to remember Buffett's own words. In the short run, the market is a voting machine. In the long run, it is a weighing machine. That means emotions and headlines might dominate at first, but eventually, reality, earnings, cash flows, and the quality of Berkshire's holdings will dictate the stock's value. And Berkshire is built like a fortress. With more than $300 billion in cash reserves, dozens of independently run businesses, and massive positions in companies like Apple and Coca-Cola, the fundamentals won't suddenly disappear. So, yes, expect turbulence, expect dramatic headlines, and panicked selling. But history shows us that businesses as strong as Berkshire eventually recover and keep compounding value. So what does the long-term future actually look like for Berkshire Hathaway? History gives us a powerful clue. And the best example comes from Warren Buffett's largest investment, Apple. When Steve Jobs passed away in 2011, the market was filled with uncertainty. Could Tim Cook keep the company innovative? Would Apple stumble without its visionary founder? For a brief moment, Apple's stock wobbled, but then reality set in. The business kept selling iPhones, MacBooks, and iPads, and cash flows kept pouring in. Over the next decade, Apple's market value exploded. What mattered wasn't just Steve Jobs himself. It was the quality of the business underneath. Berkshire is in a very similar position. Yes, Buffett is irreplaceable as a personality and symbol, but the company he built is not dependent on one man anymore. Berkshire owns more than 60 diverse businesses, each run by capable management teams. It holds enormous stock positions in some of the world's most profitable companies. And it sits on one of the largest cash piles in corporate history. That means even after the emotional dip, the long-term story is simple. Berkshire will continue generating cash, deploying capital wisely, and compounding value. The exact same things it has done for decades. In fact, many analysts argue that Berkshire is already undervalued compared to its true worth. So, if a market overreaction drags the stock down temporarily when Buffett departs, value investors could find themselves staring at one of the best opportunities of the decade. A true Buffett-style bargain created by emotion, not fundamentals. This is poetic in a way. The world may mourn Buffett, but the very company he built could become the ultimate value stock, not in spite of his absence, but because of it. So let's bring it all together. Berkshire Hathaway without Warren Buffett will feel strange. There's no denying that. For more than 60 years, Buffett has been the face of the company. The Oracle of Omaha, whose wisdom attracted shareholders from around the globe. But Berkshire is not just Buffett anymore. It's a carefully built ecosystem. Greg Abel, ready to lead as CEO. A Git giant guiding the insurance empire, and Todd plus Ted Weschler managing a massive stock portfolio. Each of them has been preparing for this moment for years. Yes, there will be volatility. Markets react to headlines, and Buffett's eventual departure will dominate the news cycle. We may see a sharp but temporary... But the fundamentals, the businesses, the balance sheet, the culture are too strong to be derailed by emotion. The real story is this. Berkshire Hathaway was designed to last. It's a fortress of cash-generating companies, diverse holdings, and a deeply ingrained philosophy of discipline and patience. And that leads us to the takeaway for investors. In the short term, emotion might create fear, but in the long run, that fear could present opportunity. Buffett himself would likely say, "Be greedy when others are fearful." If the market overreacts, savvy investors could be handed a gift, the chance to buy into one of the world's greatest compounding machines at a discount. So the next chapter of Berkshire isn't just about the end of an era. It's about continuity, resilience, and long-term growth. Buffett's legacy isn't going away. It's embedded in the DNA of Berkshire Hathaway. If you enjoyed this deep dive and want more investing breakdowns like this, make sure to hit that subscribe button, turn on notifications, and join us for future videos where we explore markets, strategies, and lessons from the greatest investors of all time.